Good morning to everyone. So we are just 17. Okay, so today we're going to have the same. So today we're going to have the same thing as we had last time. A lecture going to be followed by a quiz. So do you have any questions regarding the quiz that we did last time? So if you don't have any questions regarding the quiz, so a couple of words about your about options pricing. That's if an option is not in the money, the profit. So if an option is not in the money, the profit to the seller is the premium. Needs more time. So look, the idea of the question is the idea of the quiz. Needs more time. So the quiz is limited with 25 minutes limit. However, it does not close after 25 minutes. If you need like 26 or 27, it doesn't stop. That's the first thing. It stopped. As far as I can say, it was not like 25 minutes to everyone. Some quizzes were done in 11 minutes, some quizzes were done in 26 minutes, but probably it's a failure of the system. However, so like when the option is in the money, the idea is that if you sell an option, you sell it, you receive a premium. You have a profit if the option is not executed, if no one would like to use the option, if the option expires worthless. You keep the premium and you benefit from this trade. When you purchase an option, you pay premium in advance. So first, when you purchase an option, you pay, so you have minus. If the option is out of the money, your trade expires worthless. You don't receive any benefits. So your profit is negative. You have a loss from this transaction. You paid money, but you didn't receive anything for the money you paid. If the option is in the money, you execute the contract. So let's have a look at examples. So have a look at this slide, please. Once again, when you have a call option, it means that the call option gives the buyer the right to purchase an option. The call gives the right like to call an asset. If I sell a call option, I receive premium, I receive money, but I have an obligation. I trade my obligation for premium. So let's have a look at the call option buy-off. Here is the call option buy-off. So X is the strike. If the price of an asset here on the X-axis, on the horizontal axis, we have an asset price, S sub T. On the vertical axis, on Y-axis, we have our payoff and profit, payoff and profit on the vertical axis. So consider the call option buyer, the one who pays premium to the one who pays premium to receive an option. An option means an opportunity. If the price of an asset is below the strike, it means that an asset, like consider a strike 50. You have a contract that allows you to purchase an asset for 50 units of money. If the price of an asset is 20, would you like to purchase something for 50 if this something's price is 20? No, no one pays 50 for something that costs 20. In this case, we say that the option is out of the money and the call option buyer profit is negative. He paid premium. He paid say a call option premium. But in fact, he received no income from this transaction. If an asset price is 100, we say the option is in the money because this contract gives an opportunity to purchase an asset for 50, while this asset is traded for 100 in the market. The call option buyer purchases an asset, so he executes the contract. He pays 50, gets an asset, he goes to the market and sell the asset for 100, the market price. And that's why the transaction is beneficial. So the call option payoff, in theory, is unlimited. The higher is an asset price, the larger is the payoff. What's with the call option seller? The call option seller sells a contract, receives premium, C sub 0, that's a premium. So you receive some money in advance. If an asset price is below the strike level, no one would like to purchase an asset for 50 when its market price is 20. No one pays 50 for something that costs 20. So this call option seller, if an asset's price is 20, keeps the premium, and the contract expires worthless. If an asset price is 100, the one who paid premium to the seller gets back and executes the contract. So the counterparty of a call option seller wants a call option seller to sell him an asset for the strike price. If an asset is traded for 100, the strike is 50. The call option seller will have to sell for 50 something that costs 100. And this operation implies a loss. If you have to sell something for 50, while the market price of this instrument is 100, your profit is minus 50. If you previously received a premium, like you received 10, you adjust your profit for a previously received premium minus 50, loss from a transaction, plus 10 previously received premium minus 40. That's an overall profit. Profit of minus 40 is a loss, in fact. Tell me, do you have any questions regarding call option? It's clear. Okay, so now consider a put option. Put option is a contract that allows to sell at a fixed price. put options and call options, exactly put option as the oldest derivative in the world. Put options were first introduced in ancient Greece while they were trading olives and olive oil. It was difficult to predict whether the harvest of olives gonna be rich or not. And olive farmers and oil producers agreed olives delivery price in advance. Thus, they tried to smooth seasonal yearly price volatility. If there are lots of olives, price goes down, oil producers benefit, while farmers incur losses. If there are no olives, farmers sell olives at higher prices, they benefit, but oil producers can have insufficient funds. It's quite possible that oil producers have insufficient funds to purchase olives at increased prices. And if these parties don't negotiate, it might happen that some farmers and some oil producers get bankrupt and just leave the market. To avoid this, they negotiated delivery prices in advance. These contracts are considered the first put options. So let's have a look at the put option payoff. Right. So look, put option buyer. I purchase a contract. If I'm a put option buyer, it means that I pay premium for the contract that gives me the right to sell the asset. If I have olives, I pay premium for the contract that allows me to sell olives for like 50. That's the strike price of a put contract. If on execution date, the price of an asset, the price of the asset, is below 50, like olives, market price is 10. What is the profit for me, for the put option buyer? I sell for 50 an asset, while this asset price, market price is 10. 50 minus 10, 40. So my first, I can see that my profits, my payoff is 40. What's the profit? If I paid like $5 for these contracts, my overall profit is 40 minus 5, 35. So I paid $5, and these contracts gave me the right to sell an asset for 50. At expiry, an asset price is 10, and I receive 50 for something that costs 10. So the question, when I am the owner of the product, I'm the buyer of a put option, right? The put option is an insurance. You can purchase a put option if you have an asset, and we call this transaction a covered put or a producer's put. So if you produce oil, corn, sugar, coffee, whatever, coal, minerals, anything. And if you just like to have an option to trade your raw material for a fixed price, you pay for the put option. If you don't have an asset, you can purchase the put option. We call it a naked put. So you don't have an asset, but you purchase the put option. Why can an investor purchase the put while not having an asset? So if I believe that a particular stock gonna move down, if I believe that its price gonna decrease, like today asset price is 100, but I do believe that in 3 months time its price gonna be 10. I purchase a put option with a strike price like 50. At the time of expiry, if my hypothesis was true, the asset price is 10, I purchase an asset for 10, I execute the put options and I receive 50. So this is bear put, bear strategy, but we're gonna talk about option strategies later on. And that's why I pay so many attention to these payoffs, because if you don't understand these simple payoffs, we just won't be able to talk about like straddle or strangle on VIX. Like just you're gonna ask me like, what is a put, what is a call, what is a straddle, what is a strangle? I just don't understand anything. And to avoid these questions, please pay attention to these simple payoffs, because we won't be able to talk about option strategies if you just don't understand a simple put, a simple call. That's the reason why I'm paying so much attention to these payoffs. It's really important. So look, the payoff of a put option is limited on both sides. The profit is limited, and it is limited by the strike. It is limited by a level of the price of an asset and the strike. So if you have, you cannot earn more than the difference between a strike price and 0, right? So even if the asset price drops to 0, I cannot earn like twice the price just. And that's why the upside of this trade is limited. Well, the downside, the loss is limited as well, because the worst thing that might happen is my contract expires worthless and I lose the premium paid. So what about the this is a mistake. There should be a point option payoff. So put seller, the same thing. I have my profit limited with the premium. So I cannot earn more than a premium that I receive. My loss is limited as well. At worst scenario, I have to buy a contract for a strike price while its market price is 0. So the worst case is purchasing something for 100 while its market price is 0. Selling puts is a very popular strategy, but what is important, you should control your strike level. Mostly options exchanges require margin for naked put contracts. So you have to pass the margin on your margin account, because an exchange wants to be sure that you have money, you have X units of money to purchase the contract from the market if your option comes in the money. So the basic thing is that put contracts have limited upside and downside, while call constructions, they are unlimited. So a call option buyer has potentially unlimited profit, while the call option seller has potentially unlimited loss. Why do I focus on these obvious things? If you have an instrument, while its profit is unlimited or its loss is potentially unlimited, these instruments varies potentially with the same market conditions, same prices, same everything. The call option, there's more risk to an investor than a put option. Put option is limited. It bears less risk. This is not that risky operation, not that potentially profitable, not that potentially expensive and loss generating. And that's why selling call options is riskier than selling put options. So and call options tend to be more expensive when you trade them and more risky. So if you're willing to earn money trading options, and if you're just a beginner, it would be better to focus on put options and to avoid dealing with naked calls, because it might happen that your capital will be just diluted by margin calls. Any questions? So an average time of completing this quiz was less than 25 minutes. If you have any questions regarding some other quiz questions, so just could you please contact me via email or Telegram. If you don't have any questions left, we're going to focus on our today's topic. So just a couple of words about our course structure. First, I introduced derivatives markets. Second, we studied options. Now we're going to study forward contracts. Our target is to understand the Black-Scholes model. So I'm willing to give you basic things you need to know before you study probably structuring or market risk or options trading or probably like derivatives trading. And I give just a very basic thing. So what do we have here in our lectures is not enough to go to an interview like a quant interview or structure interview or something, but these lectures gonna give you a very basis. So if you're willing to become a quant or a structurer, a trader, or whoever, you can send me an email and ask for additional materials, additional books, and so on. And if you are not interested in like dealing with derivatives, it's very important to understand the basics, because if you're gonna have your diploma and you're gonna have a derivatives line in your diploma, I need everyone to know how to just to calculate a simple option contract to pay off. Because if you have a derivative course in your diploma and you cannot distinguish like an option from a forward, or you cannot calculate a very simple contract, that's just like, are you kidding? So this course is difficult. If you feel that you don't have enough time, you don't understand something, please look for John C. Hall derivatives book or any other famous derivative course, or Paul Wilmot, or any course from references or at your own choice. But it's very important for you to understand the course is difficult because the topic is difficult. If you need books or something, don't hesitate to contact me. So today we're going to have a talk about forward and futures prices. For those of you who are willing to become a structurer or a quant or whoever, quant interview or structurer interview, question number 1. What's the difference between a futures contract and a forward contract? The difference is deeper than what we're gonna discuss right now. And in these details, if you're interested in this topic, please Google the details. You can send me your suggestions via email. What's the mathematical difference between these two contracts? And for any quant interview or any structural interview, they want to hear the math of this question. But if you are willing to deal with derivatives as like project manager or working at operations, or probably sales or developer, you can your answer can be just taken from the lecture. This is the first level answer. So today we're gonna examine how forward prices and futures prices are related to the spot price of the underlying. So first of all, forward contract as an OTC contract. Forwards are trading between counterparties. Mostly forwards are traded between investment banks or banks and corporations. Different corporations don't often trade forwards. Futures is an exchange derivative. Both of these contracts fix an asset price in the future. They fix a date, and this contract is an obligation. So it's not a contingent claim, it is an obligation. So we're going to talk about arbitrage, about different variations of futures contracts. So let's move on. So first of all, we're going to talk about arbitrage-free pricing. You might think that it's something very, very natural, like no arbitrage. Okay, why do we have to prove it? Why do we have to talk about no arbitrage? That's obvious, right? If we have an asset that is traded, that's price is 50, we cannot have the same asset traded at like 55 because financial markets are global. If any arbitrage arises, it's immediately deleted by marketplace. So we don't have arbitrage. Why should we prove it or something? Well, in fact, lots of financial engineering and derivatives pricing uses a very difficult math, and proving no arbitrage for any selected market or any selected security is a very big part of pricing. So here we focus on a very basic things, but these things are not just words. These I give you words, but in fact, no arbitrage is mostly formulas, no words, math, science. I just don't give you these signs. So first of all, we focus on the law of one price. If two investments have the same or equivalent future cash flows, regardless of what will happen in the future, these two investments should have the same price today. When I say regardless of what will happen in the future, when I say equivalent future cash flows, in fact, I'm saying about measures and martingales and all that stuff, but we're not going to study it. If you're interested in the mathematical background, you can Google for financial market martingale, and you will have a lot of various interpretations. So if we have two assets, we suggest that these two assets have equivalent future cash flows. These two assets, we have the same price, the same present value. Note that there is nothing about probability of default of a counterparty that pays you these cash flows, or there's nothing about rating. There is nothing about survival probability of a counterparty. So there is nothing related to any sort of risk. In this definition, we have only equivalent future cash flows. But in fact, cash flows should be adjusted for risk, right? If I have a cash flow from a big corporation and the same cash flow from a small firm, a cash flow from a big corporation is less risky than a cash flow from a small firm. So we're gonna talk about these details a bit later in our future lectures, and I want you to bear in mind this phase. So if the law of one price is violated, we have again no risk. I purchase something at 50, I sell the same asset at 55, and I receive profit, and this additional gain costs me no risk. We call it an arbitrage profit. The second concept I'm going to use during this course is replication. Replication is an approach. If we want to prove that two different instruments has the same payoff, they have identical values, we gonna use replication. It is the creation of an asset or a portfolio from another asset or portfolio, etc. We're gonna use replication to prove a put-call parity, and later on, replication is one of the core methods in derivatives pricing. So we say that this instrument pays the same as a combination of these like three instruments, and we prove it. And this is a replication. You're going to see it later. So there is a difference between two terms, pricing and price, and valuation and value. So pricing and valuation is not the same. When we talk about any forward commitment, pricing means that we determine the price that is negotiated at the contract, at the initiation of the contract. This is pricing. Consider if you'd like to negotiate future or forward contract on US dollars. You'd like to purchase 100 US dollars in 3 months' time. So what's the fair price for 100 US dollars in 3 months? Suppose you have already conducted a sufficient research, modeling, and so on, and you believe that the fair price of 1 US dollar in 3 months' time is like 72 rubles per one US dollar. So this is pricing. You determine a forward commitment price, or in this case, a forward commitment rate, when you initiate a contract. we can use term price to forward futures, some swap contracts. So price is a fixed price that is agreed upon the contract initiation. So in my case, 72 rubles per $1 as a result of forward commitment pricing. This is a negotiated rate. So what's put valuation? As time passes by, things change. And a value of a contract, while the value of a contract at initiation is 0. As time passes by and things change, the value of a contract changes as well. So if we have a forward commitment, if we have a forward contract, we can monitor, in my case, we can monitor dollar to ruble. If, for example, we during the first month of a contract, we can say that the US dollar increases, and we can see that $1 costs 73 rubles, 75, and even 80. It's quite obvious that a contract in which the delivery price is 72 gonna change its value. If I have a contract that allows me to purchase US dollars at 72, while the rate is like 80, the value of the contract increases. It's a very nice contract that allows to purchase something for cheap, right? On the other hand, if the price of US dollar decreases, and we have like 68 rubles per $1, the contract that allows you to purchase $1 at 72 rubles is worthless. Who's interested in purchasing US dollars for 72 while its market rate is 68? Well, no one. The contract will incur losses because it is a forward contract. It is an obligation. You cannot avoid it. You cannot skip it. So every time you calculate the value of the contract, whether it's profitable one or it will generate loss in future, you conduct valuation. So you determine the value of the contract after the contract has been initiated. So please don't confuse these two terms, pricing and valuation. Pricing is done once before the contract is initiated. Valuation can be done like daily. Do you have any questions regarding the pricing, valuation, and so on? Okay, looks like you don't. However, the chat is open. If you have any questions, I can see them. So let's have a look at the principles of arbitrage-free pricing. That's a basic thing. These things are obvious. If you ever go to any derivatives interview, you just need to know these things. So assumptions of arbitrage. Replicating instruments are identifiable and investable. The first line is linked to Arrow-Debreu securities in financial math. But for a theoretical course, we just stop at the point that replicating instruments are identifiable and investable. Because imagine you construct a very complex structured product, like a product with barrier options, or just a combination of barrier options. To replicate barrier options, so you cannot replicate a barrier option with like stock and bond. You need specific options to replicate these instruments. And if required options are not traded, your contract is cannot be replicated. You just don't have instruments to replicate your contract. They're not valuable. And when we talk about exchange traded options or futures contracts, every time you're looking for a specific contract, you say that there is a exchange issue contracts on specific underlines with specific strikes and dates and so on. And a customized contract, like any option with any strike, is just, it's not available. These are technical details that sometimes contracts are not available by their nature. So, and that's why it's not just words. Sometimes replicating instruments are not identifiable or not investable because they just don't exist on the current markets. The second point is market frictions are nil. Why do we use a word frictions? Because mostly equations that reduced price derivatives came from physics. And these equations used a very physical friction. And this term was just acquired by financial professionals. So market frictions are nil. In fact, market frictions are not nil, but however, short selling is allowed with full use of proceeds. We need this point for replication as well. Short selling is you can sell an asset if you don't have this asset. With full use of proceeds, mean that if I like to short sell any asset at any price, I'm allowed to do so. And if I short sell an asset for 100, so I don't have a stock, but I like to short sell it. I lend a stock. I lend 1 unit of stock. I don't lend money. I take the stock, I sell it, I owe a stock, and I sell the stock I owe for 100, and I am allowed to use 100. So I don't pay any commission, I don't have to pass any margin, just anything. I can use every single dollar that I receive from the short sale of an asset. And the fourth thing is borrowing and lending are available at a known risk-free rate. So every market player can borrow or lend at known risk-free rates. But in fact, in real life, it is not true, because a small investment firm can borrow money for a higher rate than a big investment corporation that has an access to international markets and has a very high credit rating, and that's why it has a lower interest rate for lending. But in theory, borrowing and lending are available to every market player at a known risk-free rate. So, if we like to determine forward commitment price and value, we will use something that is called the carry arbitrage model, or cost of carry arbitrage. Just remember the term. It would be easier to understand as an example. Carry arbitrage implies that the underlying instrument is either bought or sold along with the forward position. Carry means carry, like carry me home. That's why carry. So I can carry an asset, or I can enter a forward commitment contract. Carry, just the same as carry a dog, carry a cat, carry me home, like this. Literally carry. I suppose you have questions regarding these arbitrage, replicating, and so on. But in fact, you don't. Okay. So for those of you who are not familiar to futures trading, let's have a look at what short selling means. So short selling is selling an asset that you don't have. For example, I do believe that the stock price cannot decrease. So today the stock price is 100, and I believe that tomorrow or in 1 month's time, its price is gonna be like 50. I would like to sell these assets, receive 100, and in 1 month's time purchase the same asset for 50. So I borrow 1 unit of asset today. I sell it. I wait. In 1 month's time, I purchase this asset for 50. And I keep 50, yes, profit, and I return a share that an asset that I have recently borrowed. While it sounds so smooth, so easy, short selling is a very tough strategy, because in fact, nobody knows whether an asset price will go down as predicted or not. That's the first point. The second, if you practice short selling, you have to post margin because the exchange would like to ensure that you have enough funds to cover your position to just purchase an asset from the market. If during your planned 1 month waiting period, an asset price goes up, increases like up to 150, your position can be closed by an exchange if they calculate that your margin, your cash, is not enough to cover this price increase. So you just don't have 150 on your account, and to avoid any kind of unfulfillment to your obligations, will just close your position. And that's why short selling is very risky and requires additional funds to fulfill any margin calls and to avoid closing your position. So short selling is not a strategy. Short selling is just gambling. And here we consider short selling just as a part of our application. So we're going to talk about short selling without any links to real cases, without any margin calls, any exchange, and so on. It's just, for us, it's just an abstraction, like short sell stock. So these two paragraphs are dedicated to what I've already explained you. Do you have any questions regarding short selling? Okay, you don't. That's a very simple slide. For those of you who don't have just these interest formulas in your memory, if you have annual compounding, you use this formula. If you have continuous compounding, your number of compounding periods increases up to infinity. You have these converts into a limit. The first limit, for those of you who studied math in Russia, it's called первый замечательный предел. So that's the limit, and that's what we have with this limit. That's continuous compounding. So if you don't have it in your memory, like make a screenshot or something. So now we're moving to the core of our today's lecture. So please be attentive, because if you don't understand something from the quiz or something, I would explain this next time for sure, but it's very important for you to probably to have these ideas, these things in your head before the quiz. So could you please have a look at this slide? Because just reading a slide aloud is a little bit ridiculous. Please have a look at these terms. We have time and a fraction of a year. We have the initial time to expiration, capital T. We have T with minus sign. That's the fraction of the year that the previous trading day represents. S sub T is the price of the underlying asset at time T, so S sub 0 is the underlying price at contract initiation, and S sub capital T is the underlying price when the full contract expires, because the T is initial time to expiration. So we use two different letters. We use F, that's the price of a forward contract. The capital F is used for a forward contract. F is used for a futures contract. The same thing with the value. We use a capital letter to determine the value of a forward contract. We use the value of a futures contract. So you can have a screenshot or something, just if you are unsure, you can keep it in your mind till the end of the lecture. So first, we start with pricing, a forward contract, pricing. So we'd like to know at what price to negotiate, which price to select. So I'd like to purchase 100 US dollars in 3 months time, or I'd like to purchase 5 barrels of oil in 3 months time. So what price to cite in a contract, which futures to choose, or what price to cite in a forward contract. So first, consider a long forward contract to purchase an underlying without any future cash flow. So an underlying doesn't pay any dividend, coupons, there's nothing. Consider it like an oil or currency. So suppose the forward price is relatively high. So the price is the forward price F sub T at T. This is the price of a forward contract. At this price, an asset will be traded at time T. If I have a forward contract that allows me to purchase 100 US dollars and pay 72 rubles per each US dollar, F sub T at maturity at T at expiration is 72. That's the forward price. So suppose the forward price is relatively high, like the US dollar is traded at 60. An arbitrageur that's a key person. This arbitrageur will be a part of nearly every lecture. Like an arbitrageur, it's a person who is seeking for free money, is willing to take no risk, is willing to invest no money, is just willing to speculate, to find arbitrage opportunities. So at time t equals to 0 at the very beginning, an arbitrageur borrows S sub 0. I look back, S sub 0, the underlying price absorbed when the forward contract is initiated. So today, $1 US costs 60 rubles. S sub 0 is 60 rubles. So an arbitrageur borrows 60 rubles or S sub 0 at risk-free rate, and that's what we'll have to pay at time t. He borrows, that is the payment due at time t, minus, because there's the loan repay. So for these 60 rubles borrowed, an arbitrageur purchasing an asset. So you'll have minus this amount of money, the present value of this amount of money, and an asset plus asset minus cash plus asset. So on arbitrageur shorts a forward contract to sell an asset at time t equals to this t. I hope you are looking at the slide. At time t, that's equal to capital T. And an arbitrageur has plus commitment. At time t, capital T equals to capital T, an arbitrageur executes the forward contract, delivers the asset, and receives a forward price. So his net cash flow at time t is the difference between a forward price, 72, in our case, that's 72. That's what was paid for the contract, and the amount of money borrowed. So that's very simple. I borrow money. I have to repay the loan and the interest. That is a loan with an interest. At due date, at time capital T, when I have to pay my loan back, I can execute the forward contract and purchase an asset. And that's what I have from this transaction F sub 0. Could you have a look at the slide, please? Because as for the rest of the course, we are going to make some similar exercises. So this is the first one, and have a look, please. And if you have any questions, don't hesitate to ask.
Hello, Professor. I have one question. Am I right that forward contract is free?
At initiation, you don't pay anything. So if we'd like to set up a contract, the forward contract between, like, I'd like to purchase US dollars, you'd like to sell US dollars. If we'd like to agree for a contract today, we don't pay each other anything. I just ask you to sell me 100 US dollars at rate 72 rubles per $1. If you believe that the price is fair,
okay.
we just say deal. And we have to, I have to purchase, you have to sell me in 3 months' time. So you don't pay anything at the contract initiation.
Okay, I got it.
Thank you for your question. Any other questions? Is everything clear? Okay, so I hope you don't have any questions, so we're moving forward. So, look, we have the same contract, long forward contract, purchase no underlying cash flows assets. That's the idea. Here we believe that the forward price is relatively high. We continue the same story. So that what we have received, net cash flow, like we have net cash flow at time t is, that's the formula that what we have. So net cash flow, this is the same formula, just moving from one slide to another. So if the forward price, like this 72 rubles per $1, that's not very good example with interest rate. Let's think about like any asset, any stock. So I purchased a stock for 72 rubles. If these 72 rubles exceeds a loan with interest, arbitrageur can buy the asset in short forward contract on the asset. If we have the opposite, 72 rubles is less than as sub-zero multiplied by interest rate factor. An arbitrageur can short the asset and buy the forward contract. Could you have a look, please, once again at this slide? So what's the idea? We'd like to prove the forward contract mechanics. And we have a hypothesis, like what if a forward price is high and the forward price during the life of the contract is higher than an asset price? And we just fantasize. What if an arbitrageur borrows money? What if an arbitrageur purchases an asset? What if an arbitrageur shorts a forward contract? And what if an arbitrageur executes the forward contract? So he has a credit, an asset, and short a forward contract. So he has another party at the contract. I can long a forward contract, and long I'm having a contract. Short, that's the same. I don't have a contract. So I have to purchase an asset if the contract is executed. And at time t, an arbitrageur executes the forward contract. It's just our hypothesis. We fantasize that what if we do this in the first, second, and the third? And on the second slide, we just analyze like, and what if we have this, an arbitrageur can buy the asset and short it for a contract on the asset. If we have an opposite, we can do an opposite thing, buy the asset, short the asset, short the contract, buy the contract. So we deduce that for there to be no arbitrage and the forward price during the life of the contract must be exactly. If during the life of the contract we don't have this, it would be very easy just to borrow money and receive profit like from nothing. If I know that an asset, if I have a contract that allows me to get an asset for 100 in 3 months' time, and at the same time, I can have a loan to purchase an asset, and an overall transaction can give me like profit from nothing. So I can like borrow 100 units of money for 3 months' time, and I can borrow some money to imagine that I can borrow some money and I will have 100 units of money at the contract execution date, but I just I don't pay for the loan and I have these 100 units of money. In this case, having a forward contract or having a loan are like identical. If something is cheaper, and I know that at contract expiration, 100 is the same as asset, having an asset is the same as having a forward contract, I have no arbitrage. If I see that having an asset, like I can purchase this asset for 90 today, and I can have 90 units of money for like $2 of interest. So I pay 90 to purchase an asset. I pay later $2 of interest, 92. And for 92 in 3 months, I can purchase something that costs 100 in 3 months. It means that I go to the bank, I make a credit, like give me 90, please, and I'll get back in 3 months' time and I will bring 90 and $2 of interest. I take 90, I purchase an asset for 90. I wait for 3 months. I execute the contract. I get 100. I take 90 from this sum. I repay the loan. I take 2 from this amount of money. I repay an interest rate, and I get $8 profit with no investment. This transaction started with no investment. I started by having a credit from a bank. And if this thing is possible, the arbitrage is possible. But in fact, no one would like to pay
no one would like to pay you like 8 units of money for free. And thus we deduce that there are no arbitrage opportunities. So I hope that this is clear. So the core idea, I start with no money. I take a credit, I start purchasing something, and I try to compare two different ways, like having an asset and having a portfolio that started from zero and from crediting. If these two different assets and a portfolio that started from crediting, if they don't have equal prices at maturity, it means that we have arbitrage. We cannot have arbitrage because if we have, market will exploit it, and thus we deduce that the portfolio that we created from zero and an asset that have equal prices, and that's how we derive derivatives prices. A replicated portfolio, an asset, link these two portfolio and assets at maturity date, and we receive a portfolio, we receive an instrument price. That's the core method. And you can apply this method for any like autocallable phonics on a basket, like structured product. I mean, the idea remains the same. Do you have any questions regarding this replicating and the entire idea?
Professor, it's clear, but I have one question. How it actually works in real life? For example, in Russian economy, you don't have a risk-free rate, right? And it means that the entity which has a lower funding costs will actually have infinite arbitrage opportunities in the forward contracts. How it actually works in real life?
Well, in fact, we have risk-free rates when you price contracts. You have several interest rates. For example, I have a contract in rubles. What do I have? I have Rodmas Prime. I have Ruonia rate. Probably I can use something like overnight rate. So all key rates are stated on the central bank regulators page, and you can have a look at the methodology and select the rate you prefer. So for example, I have a portfolio of derivative contracts denominated in rubles. What do I do to find the correct interest rate? I study contract details, timing, counterparties, market. I read methodology. I discuss with my colleagues which interest rate to map to what contract. Like we're gonna use Rodmas Prime here, we can use Ruonia here, or something, or for like Robex SUI or whatever. There are various types of curves. So these curves are basically used by different banks. And if you work for the Gazprom Bank, you have the same set of curves, the same methodologies as their colleagues in the Sberbank. So if the Gazprom Bank issues, let's say, a forward contract, and the Sberbank issues the same forward contract with the same maturity, the same online. For example, I'm just fantasizing. In Gazprom Bank, they decide to use like Rodmas Prime curve. Okay. At the Sberbank, they decided to apply like Robex SUI curve. But okay, that's the idea, because one quant team had their own idea. Another quant team like had a meeting with I don't know, with the desk or with the IPv team, and they just thought that it would be better to use another curve. So that's the difference. But in fact, we have a limited number of risk-free rates, and which risk-free rate to choose is a decision made by the quant team, the IPv team, independent price verification team, and so on. Did I provide you with an answer?
Yeah, thank you.
So you're welcome. So, and we are moving, if the idea of this replication is clear, we're moving forward. So let's focus on pricing forward contracts. Consider a long forward contract, an obligation to purchase an asset that will provide a perfectly predictable cash flows. We have a known dividend or known coupon. If I is the present value of this predictable cash flow from an asset, like I, this is the present value of cash flow. So I do believe that the asset will pay me some amount of money in the future, and I discount this future value to the present. This is the present value, the discounted future value. And for those of you who are not from like finance, who don't have a strong financial background, what is important when you operate with different cash flows? It's very important to ensure that all cash flows you work with are brought to a specific date. So if you work with cash flows, you must ensure that you work with cash flows value at a selected date. So don't omit a time value of money, because it's very important. So for those of you who have like their previous education in math or any social sciences, it's very important just to keep this in mind. Time value of money. 1 unit of money today is not the same as 1 unit of money tomorrow or in 1 year or like 10 years time. So to deal with a forward contract on coupon or dividend paying asset, we use the same carry arbitrage approach. Carry arbitrage. What if I carry, by carrying into my hands, an asset compared to a portfolio? So we use the same carry arbitrage approach, and we can repeat these same steps with having a credit, starting with 0 amount of money, having a credit, purchasing an asset, and entering a short side in a forward contract. So we can derive this. What's this? There's a price formula for a coupon paying or dividend paying instrument. This is what we have. What is S sub 0? An asset price. What is I? Present value of predictable cash flows. What do we do with this? We just we see the difference between the present value of an asset its present value of its future cash flows. We multiply them by interest rate factor. And this is the forward price. This, if an asset price today is 50, and the present value of predictable cash flow is 10, it's 50 minus 10 multiplied by A with RT, risk per rate, and T time E. That's the future price, that what we forward price, that what we will state in the contract. Like 40 multiplied by this, gonna be the price that we will put in the contract. So look, what do we have here? 9-month forward contract on a 5-year bond. Current bond price is 950. Coupon, $40 coupon, will be paid in 4 months. And here we have rates. I do believe that you have lots of questions to rates, but as far as I know, you have already had a course, so you know everything about rates, like what is a spot rate, what is a forward rate. Do I need to explain these spot rate, forward rate, how to derive what is 4 month, 9 month?
Professor, it will be nice. To be honest, I just forget how to derive a forward rate.
So that's very simple. You have a spot rate. If you'd like to lend money for 1 month, you can say that I can lend you $100 for 1 month. What about the rate? So let it be 12% monthly, yearly. So if you have 1 month, it will cost you 12% divided by 12 months, 1% per month. So I can lend you $100 for 1 month, and you will pay $101 in 1 month time. And our trade can start today and today only. This is a spot rate. This is a rate. At this rate, I lend money and a contract start today. This is a spot rate. What about the forward rate? I tell you about this opportunity to have $100 for 1 month. The contract can start today, and you will pay 1% for this month. You say me that you tell me that you'd like to have this credit, but you'd like to have this credit in like 3 months time or 1 month time. I say, okay, then in 1 month time, I'm not sure about interest rates, and I'll charge you like 1%.2. And if you'd like to lend $100 for 1 month in 1 month time. So today is like, imagine today is the 1st of September. You'd like to lend $100 starting the 1st of October till the 1st of November. This is a forward rate. The spot rate is if you'd like to lend money from the 1st of September till and repay the loan like the 31st or 30th of September, last day of September. This is a spot rate. You lend money, you borrow money right now. If you'd like to wait for a certain period of time, 1 month, 3 months, half a year, 1 year, 5 years, this is a forward rate. A rate that will be applied to any borrowing in future. This is a forward rate. So if I have this contract, look, I have, why do we use forward? Is that clear with forward rates and spot rates?
Yes.
Perfect. So we have different terms for spot rates, and we have interest, and we have term structure of interest rates for spot rates. They're gonna be a rate for 1 month, for 3 months, for any period, and we have a curve, and the same curve for forward rates. And we have lots of forward rates because in 1 month, 3 months borrowing, 5 months borrowing, 10 months borrowing, 1 year borrowing, in 3 months. The same terms in 3 months, the same terms. So there are lots of forward curves. But basically, we have 1 month, 3 months, 6 months, 1 year, 3 year, 5 years, 10, 15, 20, 30. That's a very basic amount of forward rates that are applied to derivatives and credits. So look, what do we have here? Consider a long forward contract to purchase a coupon-bearing bond, 9-month forward contract. And that's why we need this, our 9 months. So from today, that's the 5%. If I'd like to borrow money, if I'd like to lend or borrow money for 9 months starting, and the loan will start today, the rate is 5%. The term is 9 months. Coupon will be paid in 4 months. 4 months from now. If I like to lend or borrow money today, and the term is the term of this credit, the term of this borrowing is 4 months, the rate is 4%. Okay, short-term borrowing is less costly than long-term borrowing. Well, okay, it's a common thing. Sometimes it can be opposite, reverse, but however, these rates, as yearly rates. If we have 4% here and the term is 4 months, look, what do we have to do with this? The rate 4 divided by 12, this is the T, the term, like the T, term 4 divided by 12. So this is a yearly rate. You have to adjust this rate to the term. And the same happens with the forward contract. So the coupon present value. The coupon will be paid in 4 months. How do we calculate its present value? We have discount, right? Because $40 in 4 months, it is not $40 today. If I will have $40 in 4 months, today I have 39.47. So for some of you, this is absolutely obvious. For some of you, this needs a bit of clarification. And I do apologize, but I have like a course minimum. And I want every person from the group, just everyone with any background, to understand these basic things. And I want every person from this course to make these simple calculus at the end of the course. And that's why I focus on things that might seem quite obvious for those of you who study finance, for those of you who have CFA or would have a FRM. So we have to bring the present value. Look, S sub 0, that's the present value. I, there's a future value. Coupon, it's not $40 today. And that's why we bring the coupon value to its present value. That's 39.47. Okay, we use these formula. They're very simple. We have the forward price, S sub 0, 950. Present value of expected coupon or dividend. Here it is, 39.47. Okay, what do we have in this formula? RT, R. The contract duration, 9 months. We need 9-month rate. A rate at which funds are borrowed or lended for 9 months. Here it is, but the rate is expressed in year terms, and that's why we have to adjust it for the period. 9 divided by 12, 9 months, 12 months in a year, yearly rate. So, and what is 945.30? That's the forward price. This price is a price that will be stated in a forward contract for this particular bond with these market conditions. During the life of this contract, we might see any movements in interest rates. It might happen that interest rates will decrease, like 4% and 5% will turn into like 1% and 1.5%. If interest rates decrease, coupon paying bond price increase. It's very nice to have an asset that pays you $40 US, because interest cash deposit pays you like 1% or 1.5%. And interest rates change, adjust the bond price. And if we'll have a change in interest rates, the forward price won't change. The price is the delivery price, but the forward contract value will change. This instrument will increase in value, will become more valuable, because this contract fixes this nice price on a bond. Why the price in future is lower than the price today? Because of these $40. The one who will get this instrument in 9 months will emit this coupon, won't be able to receive it. And that's why we subtract this amount. This is what we are not going to get. And that's why we adjust for this money. Coupon, if I purchase this forward contract, I won't be able to get this coupon. I could probably get some further coupons or whatever, but I won't be able to get these $40. And that's why the price is adjusted. Any questions?
Yes, Professor, I have a question, and this question is about rates. Am I right that there are some risk-adjusted rates that we can use for the bonds, because it definitely shouldn't be risk-free rates, right? I'm speaking about rate 4 months, 4%, rate 9 months, 5%. In real life, where we actually derive these rates, because in case I understand correctly.
look, when we price, I basically I don't price funds, but I price loans, I price derivatives. The credit risk, or like idiosyncratic risk, you adjust the price for the credit rating for the risk. So you have something like a survival probability, and you have hazard rate curve, and you use this hazard rate curve to adjust an overall price. So first I derive a price of any security in a risk neutral measure, not adjusted for risk. Like these ideal contract in a risk neutral world is like this. And as I proceed with a particular counterparty, I had to adjust my price for loss given default, a percentage of expected value that I can get back, loss given default. So if I issue a credit like $100 and LGD is equal to like 70, loss given default equals to 70%, means that I expect that in a case of a counterparty default, I will be able to get back 30% of the loan issued, so $30. So that's the first thing I have to adjust for loss given default. Second, I have to introduce a probability of default, or mostly survival probabilities used. And the survival probability is modeled by various trees, like we mostly use trinomial trees, if you do understand what I'm talking about. So basically, we adjust a risk neutral value for probability of default, and we have like a hazard rate curve. It might be a curve or a number or just a line. Hazard rate curve is a probability, a term structure of default probability or survival probability. I work with survival probability mostly. So I have a curve like counterparty survival probability is like 0.9 during the first year, 0.88 during the second year, and I've got a curve. So then I just exposure at default for these LGD and survival probability, and that's how do we move from neutral, risk neutral measure to a forward measure. But it's far beyond our course. If you're interested in these details, I could probably share some.
Okay, cool. Well,
Yeah.
I actually understand this. Actually, banks do reserves for the credit loans provision in the similar manner.
Okay. Yeah, I think that these Basel requirements are basically similar to credits, derivatives, because Basel regards banking balance like active and passive asset and liability. And just like if you have any asset, we have to adjust it for risk-weighted assets. That's the Basel approach. And if you have a liability, you have to match your assets and liabilities. You have to calculate those things because they are similar to corporate credits and derivatives. So, So dear group, I hope you're not getting bored with our details. So, and I think that we have already exceeded our timing, and it's a good idea to make a short break, right? What do you think about having a break? And I'll leave these example here for those of you who like to study an example, the same thing. And I hope to see you in like 10 minutes, okay?
I have a small question.
Sure.
What is the difference between two words, swap points and forward points? Because I can't understand it, because sometimes people write swap points and sometimes forward points with forwards.
You mean spot rate and forward rate?
Yes, we have a spot rate and forward rate, but sometimes people calculate forward rate as taken as spot rate and plus forward points. And sometimes they say not forward points, but swap points. And I don't know, is there any difference between swap points and forward points?
We can derive interest rates, future interest rates from any type of contract. So how do we know that people would like to lend $100 in 3 months time at like 5%? We have to analyze existing contracts. So if we analyze forward contracts, we can futures contract, forward contracts, we can derive forward adjustment. So if we negotiate a forward contract, we can derive a forward rate from a forward contract. If we negotiate a swap contract, we can derive interest rate, future interest rate from interest rate swap. And in this case, we have a swap contract adjustment. There is a difference between terms. When we talk about forward contracts and swap contracts, they have different terms. Swap contracts are longer contracts. So you just won't be able to see any forward contract like 15-year forward contract. No, you just won't be able to derive any future interest rates from a 15-year forward contract because it just don't exist. No one would like to enter into a contract. I have to deliver you something in 15 years at fixed price. What? That sounds ridiculous. So if we talk about short terms, 1 year and less, we use forward contracts to derive these future rates. If I'd like to, for example, if I have a bond with a particular coupon, I have a forward contract on a bond that helps me, that I can use it to derive a rate that will be applied in future. And mid-term, I have to use swap contracts. Mid-term and long-term, I use forward contracts. Oh, I'm sorry, I use swap contracts because they have longer maturity. And if you Google for any futures, you can find long-term futures contract on US T-bills, T-bonds. That's the only contracts long-term forward swap for futures forward contracts that are on the market.
So to summarize, forward contracts don't exist on long terms. Swap contracts have longer maturities. When we derive forward rates, we can use forward contracts for some terms, and we have to use swap contracts for other terms. When we say that there is a spot plus forward, spot plus swap, we try to keep info about the type of a contract that was used to derive this adjustment. Is that clear now?
Not at all. I was asking about swap points and forward points as, for example, in Refinitiv, when you price forward, I don't know why, but they use swap points. And in Bloomberg, they use forward points. And I just don't understand, is there any difference between these two things?
Well, I didn't work with Reuters terminal, but swap points, if I got you right, means that you use swap contracts to derive these the rate. Forward points implies that you use forward contract to derive the rate. Sometimes you use forward contract for short terms, and you use swap contracts for another terms. But to be honest, I don't use Reuters, or it is now called Refinitiv.
Okay, thank you.
So, do you have any other questions?
Yes, I have. Why we use m equal to 2 in this example?
Why do we use m equal to
2.
semi-annual compounding?
Yes.
2 is the number of periods.
Okay, and then in braces, you use simply 0 or 3 without divided by 2.
Okay, so let's study this example. So while Q is the average yield per annum, we can use the same thing, R minus Q. So we adjust interest rate for the average yield of an asset. Why do we adjust it? Because if an asset provide a known yield, we don't receive this yield until we don't have these contracts. And we have to adjust its price because there is a difference having an asset and receiving these known yield, or just waiting to have these assets and waiting to have these known yield. And that's why we adjust the interest rate. And we consider a long forward contract to purchase an asset, providing a known yield. We set up half a year, 6 month forward contract. So in 6 months time, we'll be able to purchase a forward contract. So 3% is paid once during the 6-month period. The next payment is in 6 months. This
Sorry,
is like-
Professor. It means that in this example, 30% paid on during the 6 months. It means that annual rate is 6%, right?
Adjusted annual rate is 6%, right? Q, the average yield. So asset 0 as a current asset price, and we have a continuously compounded risk-free rate. So first of all, we look at the formula. That's it. What should we first calculate? We have to derive Q. Q is the average yield per annum on an asset during the life of a forward contract. The average yield per annum during the life of a forward contract. Okay. We have continuously compounded semi-annual yield. Why do we use this formula? So we can get just several slides back, probably I had it. This was the slide with interest rate. So why do that's it. So we have 2 periods during the year. We have R divided by M. That's 3% or 6, because once during a 6-month period. So it means that yearly it could be 6%. And thus we get this number. And the rest is just mechanics, continuously compound risk-free rate. So why do we use exactly this formula? If we do any operations with risk-free rate and yield or whatever, we have to bring these rates to the same basis as we did in this example. We had to adjust for the present value. So we cannot add or subtract or something cash flows in the present and in the future. When we work with interest rates, we cannot add, subtract, and using the same formula like continuously compound rate and paid once during a 6-month period, like rate that is paid twice a year. We have to convert all our rates to the same basis. It could be, and we convert existing rates to the highest frequency of compounding. So we have continuously compounded risk-free rates. We have to bring to continuous compounding this rate to be able to subtract Q from R. And this is the way, how do we convert this semi-annual compounding into continuous compounding. If you need to have a look at these formula, how do they derive, you can Google for like how to derive continuous compounding from semi-annual compounding or something like this. This is the link between different types of compounding. So do you think that you have received an answer to your question, or you just like to any other clarifications? Okay, so I hope that is quite clear. And it would be better if you look for these formulas just to keep them on a sheet of paper. So let's have a break. And I would be happy to see you here in 10 minutes.
So I hope that everyone is back and we can continue with pricing for contracts. So we are moving to value for a contract. So while pricing is an exercise to determine the price to be set up in a contract, and pricing is an exercise that is conducted once during the life of the contract. Valuing can be performed daily or weekly. So as forward contracts, as in futures contracts and forward contracts are included into the, for example, risk-weighted assets, regulatory metric, and other metrics that are required by Basel II and Basel III as well. Value for contracts and future and for contracts are made on daily basis. Well, we can say value futures contracts, but value futures contracts is done by the market, and we don't value a futures contract. We just upload prices from the exchange. So mostly banks are valuing their forward contracts that are the OTC contracts, over the counter contracts. Well, in fact, valuing is a more complex procedure than what is described here, because while valuing, we have to consider any other trades with the same counterparty. We have to consider the counterparty credit risk. We have to consider any netting agreements, while various cash flows from different trades can be netted. There might be probably any kind of CSA, credit support annex, with a counterparty. So basically, investment banks have different trades with the same counterparty. And we apply like a complex approach to value these trades, because each trade is valued, trades are netted. We have to account for credit risk, to any collateral posted, and so on and so forth. So here we cover a very basic thing, just very basic. So the value of forward contract at the time of initiation is 0. We believe that the price is fair and no arbitrage can be applied. During the life of the contract, its value fluctuates depending on the price of an underlying asset. If we use the following symbols to determine the price of a forward contract, a delivery price in the forward contract, and we have a value of forward contract. So at time t equals to 0, when the contract is first negotiated, the price of a forward contract is, so I just use letter K to simplify, because first I introduced it, the price and so on. Now we're just moving to a very simple case with a K letter, that what we have defined. Why did I use so complex like F sub T, T, and so on? We inherit these formulas from more complex mathematical concepts, and I wanted to keep the origin. I didn't want to introduce just the letter K.
we want to count the letter K, because in fact you don't have every time this simple like price, or the complex variables do exist. So, but in our course, we are satisfied with letter K. That's what you have in your contract. That's what you will get for an asset or pay for an asset. Letter K. My favorite, like 72 rubles per $1. V sub 0 at T, with T is equal to 0. So value of the contract that has time T to maturity at its initiation is 0. So we have this big T to specify for the contract duration. If we have a 3-month forward, we will put 3M here. If we have 1 year forward contract, we will put 1 year here in parentheses. And the subscript is the moment in time at which we consider the contract. 0 means that we consider the very beginning. At any time T during the life of the contract, we have value of a T timed contract, like 3 months or 1 year, at time T equals to what we have here. This should be, I'm sorry, that that's correct. Yeah, that's really correct. So if we use this, they're equal, this is 0, right? At the moment, at the very beginning. There should be F at T, there is a mistake. It's not a 0, there's a T subscript. I will correct it. Sorry for this mistake. So T, here is sub T. Okay. So the value of forward contract at the time of initiation is 0. We have to derive the value it takes during its life. So if we compare a long forward contract that has a delivery price with an otherwise identical long forward contract that has a delivery price of K, we will just compare 2 forward contracts with 2 delivery prices. Well, why not? The amount that will be paid for the underlying asset at time T differs. The present value of each cash flow, of their cash flow difference, is the following at time at 0, at T 0. And if we'd like to, so this is what we have at time T, and this is what we have at time T equal to 0. We have to multiply by this. This is a discount factor. So to bring the future value to the present, we multiply by a discount factor. And if we use continuous compounding, our discount factor is like this. Okay, we have 2 different contracts. We can compare they have different present values, and we can see these values at time t and at time 0. Okay. So if these two values are different, one contract has a lower fair value and this contract is valuable, less valuable. The value of the contract, if we consider that this contract is less valuable, is by definition 0. So the value of the contract with a delivery price of K, another contract, is the difference, right? So if we know that the value of the short is minus the value of the long. So could you please have a look at this example? It's not that crucial to understand it in details, but it would be nice if you understand it. So we have two contracts. Contracts are identical. They have delivery price, F sub 0 and K.
Excuse me.
Yeah.
I can't understand why. One moment. What is F or T? So K, as far as I understand, it is an execution price.
We just think that if there are two different contracts, the execution price in one contract is K, and the execution price in another contract is F sub 0. So what if there are two contracts? They are identical, but they have two different delivery prices. If they have different delivery prices, it means that if they have different prices, if they have different delivery prices in future, it means that the present value of these contracts are different, and they have the present value of their cash outflow difference. So one contract will pay me this, another contract will pay me this. I suppose that this is greater than this, than K. Okay, so that's what I will get at time t, but I'm at time t equal to 0 or any random period in time. I'm not at maturity. So I have to bring this future difference, future cash flow to present. So I have two different contracts. They will pay me two different cash flows. That's the difference in future, that their difference discounted to today. So I have two contracts. One has higher future value. One has lower future value. One is less valuable. Another one is more valuable.
Excuse me. Are you talking about arbitrage opportunities or just about valuation of contracts? Because I'm a little bit confused.
We are trying to derive the value. We believe that there are no arbitrage opportunity. So at any point of time, I can have a forward contract. Right, at any point of time, I can initiate a forward contract. If there is an opportunity
that I can initiate a contract today, or I can purchase a forward contract from the market, not from the market, like from a counterparty. If there is a price difference between a contract that is initiated today and an existing contract, I can arbitrage, right? I can set up a forward contract at any date in time. If there is an arbitrage opportunity, there must be a difference between these two contracts values. So, and in this exercise, we just compare a forward contract and existing one that at any point in time during the life of the contract, and a newly initiated contract, another one. And we show that if these two contracts are different, they'll have arbitrage opportunity. But as we believe that we live in a no arbitrage world, these two contracts are equal. That's the idea. Well, I will send you these slides, and you can find an explanation of value for a contract in various of sources. So the idea is just to compare two contracts. Did you get it?
Yes, it's clean.
Okay, so if there would be an option to start a new contract with another price, with another better opportunity, it would be a great arbitrage case. I launched forward and I started launching smaller contracts during the life of its contract and just receive money for nothing. It would be so nice. So let's consider an example, and probably the idea can become like clear. So we consider a non-dividend paying stock. We consider a forward contract on a non-dividend paying stock. It is a 6-month contract, and it was negotiated some time ago in the past. So here is what we've got. This is a contract. This is an annual interest rate, continuously compounded. That's the current stock price, and that's the delivery price. Okay, so we have to find the value of this contract. The first step, what if we just a second. So do you see these formula? Let's move a little bit backwards.
Yeah, we see.
Let's see the formula. We are moving backwards. An example. Okay, this one. So forget about minus I. What do you say? F sub 0. This is a forward price. So if we like to launch a contract, we use this formula, right? Just don't look at minus I, or you can look at this. What's this? The contract must pay exactly. That's the price. So if we'd like to launch a contract today, the delivery price is what we have here. This is the, so I like to launch a forward contract and asset price is S sub 0.
what delivery price should I specify in this contract? Today's price multiplied by A and risk-free rate. That's the delivery price of a contract that is initiated right today. Now we're moving to value in a contract. Value in a contract. The current stock price is 25. Okay. What if I launch a contract today? If I launch a contract today, I must specify a delivery price equals to 26.28. That's the delivery price if I'd like to launch a forward contract today. Okay. And I will receive this amount of money for my contract. There must be a timing that 0.5. 0.5 is what? Half a year. That's why 0.5. Okay. What about an existing contract? That's the formula. That's the delivery price for a contract that is set up today. That's an existing delivery price. The delivery price. We put a new delivery price in the parentheses. We subtract the old delivery price. And we multiply by a discount factor. We need this multiplication because we need to bring the asset future value to the present. And we receive $2.17. That's how these formula work. Or questions, please, or probably it's quite clear.
I have a question. Okay, do I correctly understand that it is a procedure of reevaluation of the contract, but when we create this contract, the value is 0 because
Right.
we.
Right, the value is 0.
Okay, now I understand. Thank you.
Perfect. That's very important. I want everyone to understand these concepts because if you don't understand simple concepts, it's just worthless. This course is worthless. And we are mostly working with these simple things. And after you study these simple things, you'll be able to understand some complex concepts and so on. So if you don't have any questions, we are moving forward. And if you realize after studying these slides that you have any questions, well, don't hesitate to email me or telegram me. So, and here we have just formulas for various types of contracts. Deriving these formulas is a bit out of the scope of the course, but you can find these. Just you put in any search engine like value for a contract, and you will have these formulas derived and explained. So here I just provide you with very simple. No underlying cash flow, predictable cash flow. That's what we already had. There are lots of other cases or any other types of assets. And here we have known yield. Look, when we have any predictable cash flow, we know this cash flow. If we purchase a forward contract, we don't receive this. We don't receive this coupon. We don't receive these dividends. If we don't receive it, we subtract.
If we have a known yield, we have to adjust risk-free rate for this yield. What about futures contracts? So the key difference between a futures contract and a forward contract is that futures contract is traded. It is cleared daily. It is a subject of margin calls. And next time I'll tell you about, or next, or at any time point in future, I'll tell you about contango and backwardation case when some oil traders were just wiped out of the market because of margin calls and unexpected oil price movement. And you can Google for this story or wait till I tell you about it. And there were several bankruptcies that were followed, that were a consequence of interest rate unexpected change. So traders were just, they were rolling the yield curve, they were trading futures, and they expected futures price to be higher than the spot price, but as interest rate suddenly changed, the contracts became worthless and they were wiped out from the market as well. So, I mean, don't play with futures. If you'd like to do something interesting, consider options or go to an investment bank, but don't play with futures as an individual investor. That's a way to bankruptcy. So we're nearly out of time. So look, we don't have a lot of things here. They're quite evident. So just I need a bit like 10 minutes to finish. So consider the case when the price of the underlying asset is positively correlated with interest rates. Consider a long futures position. When asset price increases, an investor makes an immediate gain because of the daily settlement procedure. The positive correlation indicates that it's likely that interest rates have also increased. The gain, therefore, tend to be invested at a higher than average rate of interest. When asset price decreases, the investor faces the opposite, immediate loss and immediate loss and immediate reinvestment at a lower rate, right? So if you have, in the first case, you have a positive event followed by a positive event, price increase, and you can invest proceeds at a higher rate of interest. Or you have two consequent negative cases. The asset price decrease and your loss is financed at a lower rate of interest. Futures are sensitive to these daily movements, while a forward contract is not affected by these interest rate movements. And this is the beginning of an answer to a question: what's the theoretical difference
between a futures and a forward position. So when asset price is positively correlated with interest rates, futures prices are higher than forward prices. In a case of a negative correlation, we have forward prices higher than future prices. So this is a not typical case, and it's a bit tricky, but I want you to know these tricky things as well. If you don't have any questions, we're just moving forward.
Am I
So-
right that daily settlement means that the counterparty will pay in case the asset will depreciate daily, just like daily settlement?
If you trade futures, what we have discussed during the first lecture, the futures exchange values position daily, and you have a margin call. If you have a futures contract, you have an obligation to purchase an asset in 3 months' time and pay $100 for this asset. Whether the price of an asset moves up or down, the exchange calculates the marginal requirements that you have to post. And according to their calculations, you have to invest additional money, put them on your marginal account. This is what the first thing is. And as the daily settlement is futures are settled daily, so margin's first point. The second is daily settlement. It means that futures contracts are settled daily, and like clear daily. And that's why you have to deal with the proceeds while you don't face the same problem with forward contracts.
It's clear. Thanks.
Thank you for your questions. That's very important that you gave questions, because it like the feedback that's really important to me. So thank you for your questions. So for futures contracts, the same thing, basically. At time zero, we have F sub 0. The price of a futures contract is negotiated so that the value of the futures contract is 0, the same thing. At time t, at the expiration of the contract, the futures price is basically equivalent to the spot price, right? So if I have an asset or an obligation to purchase the same asset, they are equivalent. So futures are marked to market daily. And futures are settled daily. And that's why the value of futures contract is a difference between the futures price from the previous day. So we have this very important. So look at the bottom of the screen. That's what I'm talking about. The value of the contract. Do you remember T minus that I introduced at the beginning? T with the minus sign is a day before. So we have a futures price today minus futures price a day before. This is the value for long. When we consider a short position, that's not with an opposite sign, and marking to market is conducted daily. and every day after daily settlement, the value is 0. That's the difference. So here we'll have a list of forward commitments on specific assets, their details. So we have stock index futures. So index tracks the value of a hypothetical portfolio of stocks. So here in this slide, I just provide a bit info about stock index. So index can be regarded as equity or something, but mostly when we price instrument, we don't distinguish index or equity. They're just the same, like equity, like traded security. So we don't include dividends into calculation. Well, if we like to calculate the index futures, we use this formula, equity futures or index futures. So why do we use these formulas once again? We have various stocks that are traded. Index as a hypothetical portfolio of stocks with their selected weight and selected proportions. We like to invest into index if we believe that the index will increase in value. Index never pay dividends, right? So we rely on its percentage increase. And its daily increase in value is considered, can be considered as an equity that pays dividends. So these daily increase is recorded as dividends. However, index does not pay any dividends. And that's why for pricing index futures, we use this, the same formula that is used for a dividend paying equity. While Q in this case is this, the percentage increase, an index that is considered as a dividend. This is a stock index feature. So forward exchange futures and forwards are very, very popular instruments, very common instruments. So there's nothing special about these instruments. So what do we have here? We have foreign risk-free interest rate and domestic risk-free rate. What do we have? We have rates differences. Please bear in mind that you have continuous compounding for both of these rates, and if one of these rates is given in any other form, you must bring them to continuous compounding. So a foreign currency is regarded as an asset that pays you a known yield. And this yield is the risk-free rate in a foreign currency. And that's why we apply
actually the same formula to FX futures and forwards. So what about commodity futures? Commodity futures differs because if you have any commodity, you have first storage cost, second you have convenience yield. Storage cost, what is a storage cost? If you have oil, you need to keep it somewhere and you have to pay for the storage. So storage cost is a negative income. It's a negative yield. What about benefits of having a commodity here and now, like oil? Having oil on paper and having oil in oil refinery, two different things. So physical ownership has a benefit. There's a convenience yield, but it's a positive income. It's a simplified approach because in 2019, we faced a very difficult thing when convenience yield convert into a negative income. So when we talk about commodity futures, first we have storage cost and negative income. I have to pay to store my income. So look, if I have a bond paying coupon, but I'm not earning this coupon and miss it, I subtract. Okay. But if I don't pay for something, it's the opposite. I miss a payment. I miss a coupon and I subtract. I miss a payment, I don't pay, and so I add this. Good, I don't have to pay for the storage. That's why we have this as asset price plus storage cost. Otherwise, storage costs can be proportional to the price of the commodity. And in this case, we add the storage cost as a negative yield. So there's a difference. There's a one-time payment, and this is a storage cost that linked to time. So the one payment, that's daily payments. And we can use these two different formulas regarding of type of storage. As for convenience yield, we have absolutely the same thing. We have a dual amount of storage costs. We can just convert it and we receive convenience yield. There's a convenient yield, right? Nice to have an asset, nice to have oil in our oil refinery. And this is the storage. We have to store oil somewhere else before moving it to oil refinery. And they must be equal. And if you'd like to, if you have to derive convenient yield, you use a storage cost. So what is the convenient yield? It is nice to have oil, but how nice to have oil in oil refinery in dollars? This equation will give you the answer. Solve it, just put numbers and find y. This will be the convenience yield, and you will find how nice to have asset, a commodity with you expressed in dollars. And the same thing for storage costs per unit. It's just we can use these formula for storage cost or another one. It's the difference. And finally, we're moving to cost of carry, the final thing. Carry the same notion. So relationship between futures prices and spot prices can be summarized in terms of cost of carry. Cost of carry is applied to financial assets, to commodity, to everything. So cost of carry is cost of having. Cost of carry is basically calculated for any derivatives portfolio for any assets. So cost of carry is a very common measure, as common as like P&L, daily P&L, and cost of carry. They're just way too popular. So that's an overall like a big benefit of having an asset. So we can distinguish cost of carry for non-dividend paying stock, for a stock index, or currency, for a commodity. Look, this is the cost of carry. We have different costs. If we purchase a stock, we don't earn interest rate on the amount of money that is locked in a stock. If we have a stock index, cost of carry is equal to interest that is unearned, but we adjust for Q earned because of index increase. Don't ask me why do I'm so sure that index increases. I'm not sure, but we believe that index on long term increases. Long term, but forwards are short terms. Well, yes, that's just, if we'd like to explain all these things, it's gonna be a course like of several years. And that was just take it. If you'd like to plunge for details, ask me for additional books. So when we have currency, we miss local domestic rates. I have rubles. If I invest rubles in US dollars, I don't receive interest that is offered for rubles, but I have interest that is offered for US dollars. And that's why cost of carry is local minus foreign. I receive foreign rate, I don't receive local. And for a commodity, we have just discussed, I don't receive low interest, but I don't pay for storing. So that's the cost of carry, and most of our formulas can be expressed like very simple. Cost of carry, convenience, yield. That C is what you don't receive, and Y is what you receive. That's a very, very simple thing. We have an investment asset and we have a consumption asset, and these two formulas are just unified formulas for a futures price. So what about your test? This topic is one of the most important and one of the most difficult in the course. I mean, just these rates, these simple formulas. So you'll have your quiz as a home task. You will be given 3 hours, but the test is you can go forward, you can go back, you can go forward, you cannot go back. 3 hours, 1 attempt. You can start at any day, at any time, but you have to complete it before our next lecture starts, because I just need to review your answers and to provide you with a feedback. So basically, that's all for today. But if you have any additional questions, you are welcome. And I'm sorry for delay. Next time, I think I will answer your questions at the end of the lecture.
So just to make it more convenient for everyone, if you'd like to listen to answers to previous lecture questions, we will just stay till the end of the lecture. Okay, so